We're live. We're live in Century City.
Live and direct. All right, welcome back to another episode of Lit Financially, the channel where we're giving you simple and easy practical ways for you to illuminate your financial game. Of course, it's your boy Marcus, and today we're going to talk about why your credit score matters when you're buying a home. We'll discuss the mind-blowing differences between buying a house with a 580 credit score versus a 700 or better credit score. And I really want to introduce my brother, Adrian Casas, who is a credit expert from Get Greater Inc. Thank you for stopping by, hanging out with us.
Of course, man. Always a pleasure, brother.
We're super stoked to have you. The numbers don't lie, folks. Even though a 580 is the minimum to buy a house, can you talk about what it means for your wallet to have a 580 credit score versus a 700 credit score, especially with your experience?
Yeah, I mean, I'm not a mortgage loan broker or originator by any stretch of the imagination. We work with these loan brokerages. We see these sort of disparities all the time. One of the scenarios that we looked at was someone with a 580 credit score and someone with a 760 credit score. And the individual with a higher credit score was saving 1.2% in interest. Someone with a better credit score, and that's in the short term, that's a month. Yeah, it's a pretty big deal. You know, if you think about what you can do on a monthly basis with that money,
with
right?
Extra $500.
But if you look at it long term, as that loan goes through 30-year amortization, the person with the highest credit score was receiving about $150,000 in an approximate interest savings long term.
So $150,000 less. They spent.
It just goes to show you how important it is to work on your credit. There's certain scenarios where, you know, an individual might feel like, okay, working on your credit with a company like ours might just be an extra bill, but really it's an investment towards your future, because you got to think about how much money you're losing on a monthly basis with a lower credit score.
Right. And it's not just when you're buying a house, it's really any big ticket item. But $150,000, that sounds like a whole lot of money that you could be saving. And you're right, It could be at least your down payment or part of another house. So you're not just saving on interest rates. The better your mortgage terms are, lower fees, and even more negotiating power with a better credit score, right? Can you talk to us about some of the things that clients could do to get from maybe a 580 closer to a 7 or a 700 plus credit score and take a step to having a better mortgage interest rate?
When someone has low credit scores, usually in the 500s, what that tells me as an expert is there's probably some sort of issues in their payment history. In their past, there's probably derogatory activity that's impacting their score. So you definitely want to try to address those items. Also, there could be a lack of credit, or there could be just way too much utilization on the open credit lines that they have. One of the things that we do as a company is we provide an analysis of the credit report completely free so that we can determine what those components are to help them.
What about, Adrian, is there any mistakes that investors that are already in the home buying process that they make with their credit while they're trying to get a loan, or things that they do, maybe things with inquiries? What type of mistakes do you see given your background?
Yeah, not giving yourself enough time to prepare for home financing. So number one, there's 100 different variations of your credit score. So even though Credit Karma might tell you that you're in 780, 800 territory,
right,
when you go and apply with a mortgage bank, they use an industry-specific mortgage model. Usually mortgage models are way more conservative because you got to think about they're funding millions of dollars in home loans.
Right.
It's going to be a more conservative model, meaning your score is going to be lower. Depending on how low it is or how high it is, it's going to impact your affordability. A lot of the things that we stress on with our community is making sure that you make adjustments prior to your application, which is lowering your usage immediately, lowering your overall debt, because that plays a role in your overall affordability. It impacts DTI, but it also impacts your credit score.
And what is DTI for the people that don't know?
DTI is debt to income ratio. Hopefully you add some debt to income ratio.
We'll do that.
What that is how much money you bring in, your monthly income versus how much money you spend, which is, your monthly debt. And if the ratio is better, you're bringing in a lot more than you're spending on a monthly basis. That means it improves your affordability or improves your ability to fund a higher loan.
So that means you get more house.
Yeah, you get more house. Just lowering your debt in preparation for your overall home goals is going to help your credit. It's going to help affordability. So it's one of the things that you want to work on if you're 6 months, a year, 2 years down the road from this goal. And then second, you want to work with a really good loan originator that isn't going to run your credit with 15, 20 different lenders and that can figure out exactly what loan product is going to be the best for you so that you can actually follow through and close on a loan.
Because if they run their credit many, many times, those inquiries do hurt, right?
Exactly. There are some benefits to credit shopping. Like if you're within a certain time window, it doesn't impact you as much, but you certainly want to stay away from having multiple inquiries at your credit because each one of those on average can impact about 2 to 3 points on average.
Okay. In my business, we get this question about credit quite often. How long does it typically take to see improvements in one's credit score?
It really depends on the type of improvement that you're doing. The creditors or the furnishers that you're working with, they'll update your balance summary to the credit bureaus once a month. As long as you're lowering usage before that update happens, then you can see a change happen fairly quickly through 30 to 45 days on the usage side of things. Now, if there are multiple derogatory pieces, that's a whole different ballgame because anytime you challenge information, legally creditors have between 30 to 45 days to respond to these challenges. And that doesn't necessarily mean that it's just going to be resolved with one challenge. Right. Sometimes it takes a systematic approach to putting pressure on these creditors and the bureaus so that you can finally see an item come off of a credit report. It all depends on your individual scenario, which is why we take pride in personalizing every single analysis that we do for clients.
Good. It's definitely important that patience and consistency are key when you're wanting to improve your credit score so that you can be in position. But I definitely agree with you. You want to have a solid plan. So I think that comes with finding the right people like Adrian, a really good loan officer that can help you be in position so that you're not just doing things all willy-nilly. You have a defined plan so that you can make things happen. Is there any other pitfalls that you would recommend that people avoid, specifically when they're trying to buy a house in regards to their credit?
One major issue is not prioritizing what's the most important purchase or financing goal that they have. A lot of times a client wants to buy a home, but they go and finance a car, or they want to buy a home, but they finance furniture, So it's like a big difference between the individual that understands how that's going to impact their overall process of financing a home and the one that doesn't.
So I make sure I understand what you're saying. Having more debt will limit the amount of house that you can actually afford.
Again, DTI, debt to income. So how much money you're bringing in versus your debt monthly that's going out.
It's going out.
The lower that debt is relative to your income, that means that you're just going to be able to be approved for a much higher loan.
Right. That's a great point that you brought up because it doesn't matter if it's 6 months, if it's a year, if it's 2 years. If you set into place a plan for you to reach your goals, it's much easier now that you know the steps you have to take, right?
Absolutely. You got to think about it like this. If you were in the middle of the ocean and had no way of knowing which way you were going, you're never going to reach the other side. You have to know where you're going, number one, right? So you have to define what the goal is. You want to purchase a home, and then you want to see exactly where you stand relative to that goal and start paving a path forward. If you're at 580, 700 is a long way.
It's a long way.
You're not going to go from 580 to 700 overnight. Number one, you got to take that, internalize it, because you're going to run into a lot of people that are going to sell you a dream. They're going to tell you, we can get you to 700 overnight. It's not going to be overnight. Usually if you're at 580, in that ballpark, you have derogatory history, payment history that's impacting your profile, and you have either a lack of credit or you have high usage on your credit cards.
Too much utilization.
We have to define what that looks like and then figure out a path to resolution. Now, lowering usage is relatively easy easy if you have the money. If you can pay off all of your credit cards overnight, you can see a boost in credit if that's like the main thing holding you back. Now, if you don't have the money, that becomes a different path. And there are solutions to that. You can always look at consolidation loans so that you can kind of move that debt over to a fixed rate, save money long term, save on a monthly. It also improves your overall usage and credit score. Now, if you are still struggling with income issues, the path from 580 to 700 is going to be further away because you may not even be able to pay things on time. And one of the biggest setbacks that we see is, sure, you have a goal of getting to the 700s, but there are self-inflicting issues that can come up, like missing a payment, adding new debt. Like these are big deals, and they also raise red flags for your credit worthiness.
Yeah, we've seen people be in the loan process, get a late payment and get kicked out of the loan process.
Yeah,
right?
They're going to be jumping out of escrow usually if they are not in the approval tranche anymore. So it's one of those things where you gotta not only prepare yourself to go into escrow, but you gotta stay in escrow and close that loan all the way through. Have a profile that stands the test of time.
What I'm seeing often is that we all want this idea of how things should be, and so people start wanting to buy a house, but in the midst of that, they go buy a new car. And all that does is, once again, when we're talking about utilization and debt, all that does is just raise your utilization.
Yeah.
Because if you buy a new car, that hurts your credit score, right?
So prioritizing what your goals are is super important. You want to stay away from adding new debt on your profile when you're looking to try to add thousands of dollars of new debt on that same profile. There are a lot of people that are saying the catchy sort of phrases that can make you think that greatness just happens overnight. I mean, it really doesn't work that way most of the time. That's more the exception than it is the rule. We can sit here as a company and say how many clients we raised 100 points in a couple of weeks or whatever, but the truth is that most clients require a system. They require an action plan that actually meets them where they are. Create a profile that's going to be something that a loan underwriter is going to look at and say, oh, this is going to be a smooth process for this person. So you want to seem like a favorable person to the banks. Our job is to try to help you become that.
And to your point, there's so many people promising overnight success. And I think anybody that studies finance knows that that's just not the case. So if you really want to see yourself accomplishing your goals, you have to be able to commit to a process.
Yep.
Right? But for everybody watching, remember your credit score can be your biggest friend, or it could be your worst enemy when you're buying a house or any other big ticket item. Don't buy a car right after you buy a house, right? Definitely take it one step at a time. Don't buy the furniture before you buy the house.
Don't celebrate, getting the approval of your loan and, getting into escrow with going to buy the furniture. I mean, it's one of the biggest mistakes.
We're really here to help you absolutely rehabilitate your credit, and so that you can save and be in a position to make those future purchases that you want. If you have any questions about how you can either fix your credit or get a financial plan tailored towards you, we'd love to offer you an absolutely complimentary financial needs consultation. You can go right on to www.round2finance.com. That's round the number 2finance.com. We'd love to have you chat with us and get you set up so that you can be successful. Definitely don't wait. Start on your journey to financial freedom today. If you love saving money and you want more financial tips, make sure that you smash that subscribe button, hit the like button. Thank you, Adrian, for hanging out with us. My brother, I appreciate you so much.
Yes.
And we'll see you next time on Lit Financially. This is Lit Financially. Peace.